Most of what you hear in the financial media right now is noise designed to keep you clicking. The market is at an all-time high, or the market is about to crash. I don't trade the market. I trade individual businesses and the massive gaps that occasionally come up between their price and their actual value. Today, I'm looking at three of the biggest names in the S&P 500: Netflix, Costco, and UnitedHealth. On paper, they're all blue chips. But in reality, they're telling three completely different stories. I'm looking at one that is a glaring buy opportunity, a stock I'm actively adding to. I'm looking at another that is a flawless business, but one where the price is not quite where I want it to be to jump in. It's forcing me to sit on my hands. And finally, I'm looking at a third stock where the fundamental narrative, the very reason people have owned it for the last decade, has been effectively shattered. I'm not here to tell you what to do. I'm showing you what I'm doing, based on the numbers, the historical averages, and the current structural shifts in these industries. Let's start with the one I'm buying. Let's talk about Netflix. If you look at the headlines, you'd think the company was in a death spiral. Since the 2025 peak, the stock is down nearly 36%. The narrative? Their $72 billion acquisition of Warner Bros. Discovery was a desperation move. The market hates it. They think Netflix has run out of ideas and is just buying growth. I disagree. When I look at the data, I see a historical anomaly. Right now, Netflix is trading at a PE of roughly 34. To put that into perspective, their 5-year historical average is around 44. We're looking at a nearly 25% discount to where this stock usually trades, even when growth was slower than it is today. The market is punishing them for the acquisition cost, but they are ignoring the result. Netflix now has a combined subscriber base of over 325 million. They have the largest content library in existence, and their ad revenue tier is scaling faster than anyone anticipated. In my view, the fair value for Netflix is somewhere between 105 and 115. At its current price, I believe the downside is capped by the sheer gravity of its cash flow. I'm not trying to time the absolute bottom. I'm building a library of shares here because historically, when a dominant market leader trades this far below its mean PE while still growing the top line, the rubber band eventually snaps back. I'm not worried about the next 3 months. I'm looking at where this stock sits in 2028, when the Warner Bros. Discovery integration is complete and the debt is being aggressively paid down. For me, Netflix is one of the clearest buy signals I see in the market right now. It's a giant that's been beat down by temporary sentiment, and I'm taking the other side of that trade. Next, there's Costco. This is, in my opinion, one of the best run businesses in the history of capitalism. Their membership retention rate is effectively an annuity. Their scale is the moat that most companies couldn't build in a century. I want to own more Costco, but I cannot at this price. Right now, Costco is trading at a PE of right around 52. Look at its 5-year average of 44. It's currently trading at a 37% premium to its 10-year mean. What we're seeing here is a flight to quality. Because the rest of the market feels uncertain, investors are piling into Costco like it's a high-yield savings account. They're treating it as a safe haven, and in doing so, they've bid the price up to a level where there's zero margin for error. If I buy here, I'm essentially betting that Costco will continue to trade at a massive premium forever. But markets are cyclical. Eventually, the quality trade will unwind as investors find better value elsewhere, like in the Netflix play we just discussed. My fair value for Costco is in the $780 to $810 range. That's where the historical mean reversion sits. Am I saying it'll drop to that level tomorrow? No. But I am saying that as an investor, my job isn't to buy great companies at any price. My job is to buy a great company at a price that guarantees a margin of safety. I'm waiting for an entry, I have a price target, and until Costco hits that target, I'm staying disciplined. I'd rather miss a 5% move to the upside than buy into a 20% mean reversion to the downside. Costco is a compounder, but even a compounder can be a bad investment if you pay too much for it. Finally, we have to talk about UnitedHealth. This is the one that has changed the most in the last few months, today in particular. For a decade, the narrative for UNH was simple. It's a massive, predictable growth engine fueled by the privatization of healthcare and the expansion of Medicare Advantage. It was a sleep well at night stock. The narrative is dead. It's not just broken, it's shattered. The January 2026 Medicare Advantage payment rate proposal was a disaster for UNH. The market expected a 4% to 6% increase. They got 0.09% increase, 0.09. When you factor in medical inflation and the rising cost of care, that isn't a flat rate, it's a massive pay cut. But it's worse than that. In 2025, for the first time in nearly 20 years, UNH missed its own guidance. They've suspended profit forecasts because their medical care ratios, MCR, are out of control. People are utilizing more health care than the models predicted, and the government is paying less than the models predicted. UNH is trading at a 18 to 19 PE, which is well below its 24 to 25 PE average. On a screen, it looks cheap, but I believe it's a value trap. The fundamental reason to own UNH was its predictability. That predictability is gone. We're looking at a minimum of 24 months of structural repair for the business. The narrative that you could just buy UNH and watch it grow 10 to 12% every year regardless of the economy has been proven false by the current regulatory and operational environment. I'm not interested in trying to catch a falling knife here. I am avoiding UNH because I no longer have conviction in the long-term growth story. The data tells me the business model is facing its first real existential challenge since the global financial crisis. And until I see a path back to predictable earnings, I'm out. So that's where I'm at. I'm buying the fear in Netflix because the valuation gap is too large to ignore. I'm practicing discipline with Costco because while I love the company, the current price is just too high. If I see any weakness in Costco, I will definitely revisit a buy there. And finally, I am flat out avoiding UNH because the story that most people would buy into no longer exists. Investing isn't about being right all the time. It's about having a process that you can trust when the market starts to panic or gets overexcited. This is my process. I'll be watching the earning calls for all three of these companies closely over the next quarter to see if my thesis holds up. If the data changes, I'll change my mind. But for now, this is what I'm doing with my capital. Thanks for watching. I do sincerely appreciate your time. If you'd like to see more of this type of content, please make sure you subscribe and drop a like. And as always, I will catch you in the next one.